it is really okay. There are people that are as good or better than you, and it's not a bad idea to bring them into the fold if they're going to start to multiply your income.
All right, welcome everybody. We've got a fun one today. Before we get into it, how's business, Mason?
Business is going. It's an interesting time in the market with, tariff uncertainty, everything going on. We're recording this in April, and the market is up and down all over the place, but land is a consistent asset class to be in. And our guest today has found a way to invest in real estate and land in a way that's really, really creative. So it was a fun show.
Yeah, man, this was one where I wish I could go back in time and listen to it in 2017, 2018, because, man, some of the points he made, they hit home. They hit home. So you want to tell our guests who we talked to today?
Yeah, absolutely. So today we had the pleasure of interviewing Logan Fullmer. Logan, after graduating with a management degree from the McCoy College of Business at Texas State University, worked in project management, oil field services, and real estate. Since leaving corporate America, he's participated in the real estate space as a principal, LP, and GP to flex/industrial income property, land development, and what he really focuses on is distressed asset projects and turnarounds. Today, Logan manages a portfolio of related companies that deliver assets from inefficient to efficient markets by way of value add, workouts, and owner aggregation and technical solutions. So without further ado, let's bring Logan in.
Logan Fullmer, welcome to the show.
How's it going, guys?
We're great. It's a busy spring, lots going on, buying, selling, building, and everything in between, as I'm sure you know. But I was looking at your Instagram before we got on here, and you have some wild stories. And there was one in particular that stood out to me that I thought would really exemplify one of the points we want to make. And so if I say you got a contract signed in a bathroom, does that give you enough information to tell the story?
Yeah. Yeah, it does. Oh, man. That's a really neat story, actually. One of my close friends growing up, his sister married a guy who I met in college, so close to me. He was selling beer as a beer rep for Heineken to all the gas stations and whatever after college. Calls me and says, I've been trying to learn about real estate on the internet, bigger pockets, all the wholesaling stuff. And some guy, he agreed to sell me this property. And I think it's worth a lot more than he's willing to sell it for. I said, okay, good, buy it. And he goes, well, I don't know. I don't know how to make the contract. I don't have any money. I was like, oh shit, okay. Is that why you want me? Nothing but the address. Realized the property was worth about 150 grand in his contract. Well, his oral agreement was for 50 grand. So I'm like, all right, as it stands, there's a 100K margin. And this guy tried to sell it to others in the past, but there was a missing trust. And the property was titled the name of the trust. And the man's son had been in prison, was just released to like some kind of supervised program. So it was just hard for people to get this done. I thought, for 100 grand, I'll do what it takes. So I agreed to do a deal where I would get a larger percentage of the proceeds from the guy who brought it to me. It was like a 90-10 split. I said, I'll make 100 grand. You get 10, I get 90. But I'm going to do this thing as opposed to you walking away. And he said, great, I just want to learn. That was actually the start of a partnership. We still are partners together today. And the next time he came back and said, I want 50-50. And I said, you earned your stripes. Let's do it. But what we did is the guy, it was going to take months to get approval to meet this guy, have contact with him. And the son had to sign the contract because the son was the trustee of the trust. Daddy was old, and there was no trust document. So we had to do a trust certificate. We had to get all this information about the trust to get a lawyer to do this trust certificate for him. And we were trying to move fast. One of my big rules is when someone tells me they're going to sell me something for 30 cents on the as-is dollar, I'm not waiting. That thing's getting signed before the sun sets. I don't care if I'm driving to Houston and meeting a dude in a bathroom. Like, I'm for real. Treat it like someone's holding 100 grand in their hand and saying, here you go. You're going to call them back next Tuesday. You're going to show up after lunch, or like, you're there. So instead of waiting a month to go through approvals and all this stuff, the guy said, I'm going shopping tomorrow with my, I don't know what it was, like a supervisor or someone, trustee or something. I don't know. The person that made sure he didn't do any more bad shit, basically. So we met him in a stall in the Walmart bathroom. We signed a contract. And the dude couldn't even use a phone without like registering his calls and stuff. So it was like impossible to get this done. Met there, took it over to title. And at that point, I got the contract signed. Even if we don't close quickly, this is a legal agreement. I'm getting the house. We're good. So after that, we got authorization for him to sign the closing documents and went through all that stinking process. But to get the contract signed, man, it was fast and weird.
Fast and weird indeed. And there's a couple points I really want to pull out of there. First being the urgency of getting it under contract. When you know you have such a deal, that is everything. Get it into escrow, get your deposit in so it's a legally binding agreement, and you have that control. And then from there, you can sort out the next part, which you did as far as getting them to sign the closing docs. And the second point, I don't think many people that don't do this every day realize the extent to which you have to go a lot of times to fix these problems, to get these deals. I mean, I bailed a contractor out of jail. This crazy stuff happens all the time in real estate. And a lot of times I think people just see the net number and think you just, sent a mailer and easily got it under contract and had a clean, clear title commitment and closed it. And that's just rarely the case.
Those clean, easy deals have small margins because they're easy to get to, low-hanging fruit, lots of competition, and the margins have gotten even smaller. But the people we're looking for, the people we're dealing with, they're the hardest people to find, the hardest people to deal with. They have the biggest problems, which they would never solve on their own. And these are all seller problems, not buyer problems like us. But if we have the opportunity to make an outsized income or check, we're going to do all the things that are somebody else's responsibility, because at the end of the day, we take ownership, we get paid when we perform, and that's why we step out there.
So Logan, you've been on the podcast circuits. I know you've got your newer podcast that you're hosting has been coming out, but what you're focused on primarily is the way you go about making deals happen, focused on distressed property acquisitions, and it feels a little bit more like you're asset class agnostic, within real estate, but kind of all over the place. Can you explain why this works and how this can be identified as a niche where people say riches are in the niches, but I think they apply that to the asset class rather than the method of acquisition?
You bingo. This is a niche. Although it's not asset class niche, it's acquisition model. Frankly, if you would sell me, I don't know, mouses that are worth $10 for $3, I would buy, I don't know, $3, $4, $5 million worth of these. There's no bad product, only bad pricing. The reason I don't want to deal with mouses, though, is because they're so low cost per unit and it's not efficient. Real estate is very efficient because it's a lot of dollars per unit. So that's, I think, why we landed on that asset type. When you get into the classes, again, it is agnostic. Ultimately, I don't really care what kind of property it is, but I care about how I buy it. And the reason I care about how I buy it is because that's where the discount comes in. So whether I buy a mobile home on an acre or 60 acres or a house downtown or a warehouse, I bought apartment complexes, like everything you can imagine. Now, I will tell you what the typical asset looks like the average asset, the avatar of what we see more often. But at the end of the day, yeah, I'll take anything. I try not to deal with property that's worth less than $100,000 because as you build 20 people here in the office, we have opportunity costs at this point. I can buy a $30,000 property for $5,000 after sales costs and legal and whatever. I make $15,000 after I resell it. Or I can do that same work, literally the same curative work, on a $400,000 property that I bought for $50,000. The difference is I get to make $250,000 or $300,000 instead of $30,000. It's, strangely enough, is the identical amount of work.
Yeah, absolutely. And I think something I wanted to focus on a little bit is oftentimes the judgments or liens or anything that's encumbering the property, the cost of curing it might be worth more than the property actually is. And I imagine you're able to resolve that by focusing on this higher price point. But for whenever it's really close, when do you determine whether or not cut your ties, don't do the deal versus, hey, maybe there's a creative solution here to make the actual cost of the lien or judgment reduce to make the deal actually happen, if that is the case?
Many times, if it's an older judgment, you've got a lot of leverage on getting it either removed or just completely negotiated super, at a huge discount. If there's any question about could this deal even be close and possibly not worth it, you're already too far into I don't want to do it land. So it has to be a no-brainer, obviously great deal from the beginning, or I won't even come close to looking at it. Like if our starting point doesn't make you at least 50 to 100 grand, I don't even gonna touch it. Now in the early days, we would buy these $50,000 lots for 10 to 20 grand, cure the problems, resell them, and make 20, 25 grand off of 20 grand or so. Those were great. And we had a surprise. We did a deal in a bigger county north of us, Travis County. It was the same work. And instead of being in this thing for 20 grand and selling for 50, we were in the lot for 100 and sold it for 500. It was the exact same work. And we got to make 400 grand in the same amount of time of the same work. And at that point, I realized, gosh, no more of these small deals. So if it doesn't look like a home run from the beginning, I don't even come close. But, these judgments, let's say you have a $10,000 judgment lien of any sort, that can be negotiated as easily as a $200,000 judgment lien. The first step, though, is making sure it's good. Because a lot of times, the judgment or the lien or whatever can be not written correctly or not filed correctly, or actually against a similar name, but not exactly this one, or it's been recorded for over 10 years after the order date. And once you get beyond 10 years, most of the involuntary liens and judgment liens in Texas are not collectible unless you refile them. So 50% of the time, that lien is no good anyway, but the problem is title companies throw everything they find on the title report in the Schedule C. And they don't tell you that. They just send you the Schedule C that has all these things on it. And for the inexperienced, you got a problem. 50% of those go bye-bye just with an inspection and asking the title company, please remove this because it's a 14-year-old judgment lien. And in Texas, the statute's 10 years on that. Please remove this one because this is Johnny A. Hernandez. Our guy's Johnny B. Hernandez. We'll send you an affidavit stating so. You get half of them going just like that. The other half, you're going to have to call and negotiate and try to cut a deal. But I never tell the creditor, I don't have an obligation to that creditor. I got an obligation to me. That's it. So I don't tell that creditor I'm trying to negotiate this to clear a real estate transaction, because if you do that, like most people do, well, they know that they have leverage on you, and they're not going to cut you a very good deal. If I tell them, hey, I'm trying to help somebody clear up some problems, that's true, and I'm willing to settle this with you, $200,000 judgment, it's 9 years old, it's going to be uncollectible a year anyway, I'm willing to give you $5,000 for it. These people are broke. You haven't gotten anything out of them anyway. At least this $5,000 will cover your legal fees. Would you do that if I pay you tomorrow? Happens so often you couldn't believe it.
That's really interesting. Yeah, we had one recently. It was an IRS lien, so I doubt that one would have been fixable. But have you dealt with any government, negotiated with the government ever successfully?
You have to treat them differently because remember, your counterparty is the government. And if you do something that is questionable, well, let me say it this way. You shouldn't do anything that's questionable anyway, but you can be much more aggressive when it's just standard private creditors, and they might argue that they don't like the way you handled it, or you might have a dispute. But when you're doing that with a stakeholder like the federal government, there's no room to be even close to the line because they have so much more authority, and you don't want to come anywhere near that. But the interesting thing is IRS liens still have statute of limitations, and you've got to look at that IRS lien, and sometimes it's indexed to the individual and not indexed to the property. That's different. Sometimes you have a lot more ability to discuss a settlement if it's a little bit older, if it's not indexed to the property. So there are times where we'll try to negotiate on the behalf of the creditor, or I'm sorry, the debtor. And we don't really give a reason unless they ask. We won't disclose things, but yeah, there's negotiations that can happen there too. The IRS knows that when it gets beyond a certain point, the probability of collection is very low. Most of these IRS liens, here's what happens. Mason and Dan's business is having a tough year and they didn't really make a lot of money. The last thing they're going to do is call the CPA and go spend $5 or $10,000 filing their tax and going through all this paperwork. They're towards the end of this business anyway. Fuck it. That's what happens a lot. Or it's some tough years and someone just doesn't file. The IRS takes those 1099s and they calculate all the revenue that they know that has been reportedly paid to you by subcontractors and other people. They tally all that up and say, here's what you owe in taxes. You didn't file a tax return. Here's the levy. But the problem is they don't include your expenses, your deductions. They don't include exemptions, none of that. So it's a much higher bill anyway. And then they tack on fees and whatnot. So another thing that we've been able to do is grab the debtor and put them with a CPA and a bookkeeper and say, let's go back. You missed 3 years of taxes. Let's go back and get your paperwork and actually file those missing tax returns. And we can get this judgment down for this IRS lien down from $200,000 down to $30,000. And I'm going to offer them a $15,000 settlement. IRS takes it. So that might cost you $10,000 in work, but you made a deal that wouldn't work, now work, and we get to make a lot of money.
Yeah. Yeah. Interesting. So one big kind of more conceptual question I have around all this is for, let's say someone has a land or a flipping business of any kind, land, houses, whatever, and they want to move to more of a curative title model. Now, talking through these with you, a lot of these are decently complex, more of a protracted timeline. It takes money to get the job done, whether it's hiring the CPA like you just talked about or needing an attorney's help. And so some of it feels like there's a very high, there's certainly to some of this, a very high barrier to entry, both in ability to just put money out and wait for that return and not have to make money on that investment quickly. Where would you start? Is there a specific niche within the curative title world that's more feasible, maybe quicker, doesn't require as much money out of pocket or require an in-house attorney? That would be a good place to start.
A lot of the examples I give, I don't categorize them by timeline or cost or whatever, but you'd be actually shocked at how many deals. One of the guys in our coaching program right now, you're shocked at how many of these deals don't require a huge amount of capital. There were two siblings that were fighting, and the property's worth about $150,000. He'd been talking to him, didn't know what to do, kind of ignored it. Well, when he got in our coaching program, he brought all these deals that he couldn't solve and said, let's fix them. Dude, we're fixing two of them right now. And he gave a guy $2,500 for his deed. The other brother, $2,500 for his deed. So $5,000. That's it. There's like a $10,000 or $17,000 tax bill, but the tax foreclosure is not pending. They're just starting to file tax lawsuit. So in this case, we made sure his title's clear, only required an affidavit of heirship and getting these two deeds recorded. And then there's a tax lawsuit out there. But, he asked me when to pay the taxes, how to pay it all. And I said, whoa, Alan, no. Go trim the grass, board the place up, put a lockbox on it, clean the trash out of the house, put it on MLS now. Don't pay those taxes until you sell and pay them at closing time. So it's no money out of pocket. Escrow settles and pays it out of your proceeds. He's in this thing for $5,000, another couple grand for cleanup. Dude, less than $10,000. And he nets over about $100,000 on this deal. So there's a lot of deals. If you're very creative and careful, you can manage your money that way. But some of them require the capital. So in the beginning, like if someone's running a house flipping business and they have a couple of these deals that they can't close and they want to attempt them, I say don't burn the ships. Continue doing your business. It works and you pay your bills. Try a couple of these on the side. And surprisingly enough, if you continue to ask why, here's a problem. Why? Here's a problem. How? Keep asking that. That's how we got to the end of the road. You would be very surprised if you're careful about maybe purchasing interest. Like I had people want $1,500, but the property was like mega valuable. I'll give them $10,000 down and I'll owe them $100,000 lump sum to be paid in the next 24 months or when title is cured, the sooner of the two. I'm only $10,000 out of pocket, but I owe them another $90,000. Seller finance deals, you can do installment sales. There's a lot of ways to manage your capital down. And at the end of the day, yes, you're going to have to spend $5,000, $10,000, $15,000. But if you're in the investing business in real estate, can't come up with $20,000, then you need to go back to wholesaling or flipping and build your capital to do this. But there is no other place I know where you can spend $20,000 and make $100,000 in a 12-month period. Like that doesn't exist. So this is where the retained earnings and the savings should be.
Yep. Yeah. So emphasis on creative deal structuring, I think, is a big part of that there.
We didn't care about it at the beginning because we were really preserving capital and growing that way. But right now they got 150 properties in inventory. That's not like our portfolio. That's inventory. We will turn through all of that within I bet we turn through 75% of that by the end of summer, and the remaining 25% will take another 12 or so months to do. But when you get to that kind of capital commitment, it's strange. In the very beginning, you don't have any money, so you got to be creative. Then you start to earn it, and now you're like, oh, I got money, no big deal. Well, when you really start to optimize this business and grow it, then again, you say, I got 150 units in inventory. Guys, y'all need to be structuring some creative stuff right now until summer so we can turn more capital around.
Yeah, it can sometimes feel like you're dirt rich and cash poor in this business, depending on how much income you have coming in at any given time. But Logan, we get deals like this that come into our pipeline just through our typical marketing channels of direct mail or cold calling or texting or whatever it might be. But it's more accidental rather than targeted. How do you go?
People is already in your CRM, dude. I tell you, are you speaking gigs? Where's your first deal? You already talked to them. You already have a title commitment. It's in your CRM.
Oh, yeah. But how do you target these types of deals specifically that have the multiple owners or heirship issues or need curative title work?
I'm problem agnostic too. I don't care what kind of problem it is. It might have multiple owners. It might have judgments or liens. It might have a break in the title chain. It might have a bad instrument in the title chain. Might have missing owners, fraud in the title. I mean, there's a million things, but here's what I found. This was just remarkably interesting to me. Over the first couple of years, the first year back in 2017 or 18, I did a year-end review. And I looked at all my deals and realized there were a few of them that were just whoppers, and they were the ones that I had to do all this work on. And from the beginning, I was smart. I traded them down. A lot of people do all this work still to do their $15,000 wholesale deal. I went back and said, if I'm doing all this, I'm paying you almost nothing. And it worked. I acknowledged those couple outlier deals and thought, I wonder if I look for these intentionally. So the next year I was calling wholesalers, realtors, flippers, escrow officers, asking them for the deals that couldn't close. And then then we were scraping judgments and liens out of the land records. I mean, we went through all these phases. But what I started to find over several years of doing it systematically, the most common factor across almost all the deals is they're delinquent on taxes. Almost every one of them. So it's much easier, more efficient to pull a delinquent tax list and market to that because most of those properties are vacant. Most of them they've already forgotten and given up on. And if they're delinquent on taxes, that means there's no mortgage. Otherwise, the mortgage company would be having taxes. So you have more equity. So it's one of my favorite lists anyway, but I haven't run a study, so I can't tell you perfectly. But I'll tell you, probably half of that delinquent tax list also has title problem. So we go delinquent tax.
Yeah, makes sense. Of if the percentage is there already, then that's an easier list to target. But you've got creative financing on the acquisition side, creative financing sometimes on the dispo side. I know you're selling properties on notes. What is your team structure to be able to manage all of this if you were to, simply break down your org chart?
So I didn't grow by hiring in the beginning. I realized that hiring people, you can generally get to a certain quality, but when you find something that's as entrepreneurial as you, Mason, or you, Dan, it's really hard to keep them as an employee. And those are the outliers. Those are the stars. Those are the guys who are going to go in to do massive things. And I acknowledged that early on. I had some friends in the tech space, and they were all getting equity in companies. And their equity wasn't worth anything until the company exploded, and they were making, they were millionaires. And I remember thinking all these other people that I was coming up with in the real estate space were always getting screwed by the investors. Like, they'd come and work with them in bird dog form, and the investor would break them off a little and run them off. And I'm like, first off, it made me hate small cap investors because they're pieces of shit usually. But sorry, not y'all maybe, but that's really common. And I hated that. So I remember thinking, every time I look at something, I say, can I just do this a little bit better? Or is there any way I can do it better? And when I met Ryan, I remember thinking, I was forecasting, I'm going to train this dude. We're going to get good. And after a couple of years, he's going to go off and do it on his own. And I thought, let me just make this dude a partner. So after working side by side for about a year and a half, I started an LLC. I get half, he gets half. I capitalized it. I said, you go do these deals, man. You get half. And I encouraged him to hire an assistant and a salesperson. And he started to develop that business line. He's an owner. And frankly, he ain't going to get a better deal even if he goes out on his own because he doesn't have the the support that we've created around him with legal, genealogy, office, finance and accounting, it's a smoking deal. That's how I grew the first time. And when that worked, I thought, let's just do this again. So now there are 6 partners in the office and got a share of all those entities, and I've kind of helped nurture them all. So I've taught each of them how to hire people and manage and grow. And that's how we're able to handle such complicated stuff at a high volume. I got a dude equally as good as me running each of those business lines. So you got some real talent here. So that's how we got the expansion to happen. But in total, we still only have 20 people in this office, which sounds like a lot, but we could be $30, $40 million a year in sales at, the margins you hear me talk about. And I think it's a very respectable volume for the people we have. We've got me and one of the other partners are kind of like the managing partners, and then the other 4 are running deals. We've got 1, 2, 3, 4, 5 people doing sales, which is really acquisitions, but we just call it sales. Got a genealogist, an attorney, and then I've got AR, AP, and then the balance of people are administrative.
Okay. Yeah. I mean, and with the margins you're talking about, it supports it. But what percentage of your income is allocated towards salaries, wages, and benefits?
I have to go back and look at that report, but
Best guess.
I bet we're probably about 600,000-700,000 in salaries. Now there's commissions on top of that.
Sure.
But when I ran into the very first assistant I ever hired wasn't that good, and it was frustrating to me. And I remember making a decision to pay more. Instead of paying $20 an hour, I started paying $30 an hour for an assistant. And this was 10 years ago almost. So that was $60,000 a year for an assistant. That was good money. And I got a person who was much more accountable. They were smarter. They were harder working. And I learned early on, we pay really well. So that's allowed us to get some of the best talent that we could possibly find. So we're not chintzy, and we have a good business. And when you've got a good business, if I die with another couple $1 million in my pocket, my life doesn't change. But if I use that to pay good people, man, life is so much easier. Business is so much better and smarter. So I've found it matters to us that way. I bet if it's all said and done, not including commissions, because I got my sales people making anywhere from $100,000 to $300,000 a year. So they're doing good because it's a good business. But we're probably less than $1 million in salaries.
That you really got me thinking there. Essentially, I mean, not in the legal regard, but essentially what you've created is almost a franchise where you got 6 different companies with really competent people running them, and you take a piece of each of them. And it's got me kind of kicking myself. My best salesperson I ever had wanted to start his own business, and he said, "Hey, can we just be partners?" No. I mean, what do you mean be split? In hindsight,
But in that moment, why didn't you do it?
Greedy Dan.
Maybe, but no. Really, what it is just having to make joint decisions. I'm used to being able to just make decisions and kind of run the ship myself. And so the idea of having to pause and make decisions with someone else is something that would be challenging to swallow for me.
Well, what you're saying, in other words, is that you're the smartest person in the world. There's no one that can make a decision smarter than you, and you would never let another person make the decision over your final verdict.
No, not actually. I think it's more, and then this has evolved over the years, but started a business for freedom and the ideal of independence. And so that is more of what was on my mind. But your point is very valid. And so
I'm not big money. I'm just,
no.
You should. He deserves it.
I've been through those decisions though. I remember there was this struggle. The first person that I partnered with, I remember thinking, why am I giving him half of my business? Well, first off, my business wasn't worth anything at the time, so I'm giving him half of fucking nothing. But he brought a lot of capital, brought a lot of knowledge, and it really helped me grow. And I remember my mom saying, why are you giving half your business? I'm like, Mom, what's my business worth today? Nothing. But I knew that together with that person, I'd get to own 50% of something that could be really big. And I remember thinking of guys like, I don't know, Donald Trump comes to mind. His name is Trump. He's the leader, like he's the sole owner. And that is so rare. I mean, even like Microsoft and Apple, those have a string of owners. Now you hear about one of them, But all of these big companies are owned by multiple people. There are a lot of good people out there. And you might be the managing partner, or you might not be. But when you have a bunch of bright, hardworking people, you go so much further, so much faster. And a lot of entrepreneurs want to control. Like I had the exact same problem. I had to really work hard to get over this. But it is really okay. There are people that are as good or better than you. And it's not a bad idea to bring them into the fold if they're going to start to multiply your income. But to me, more importantly than that is picking the right people. That is the kicker. Because all the things you're afraid of don't matter if you pick the right people. If you pick the wrong people, you should be afraid because they're all going to be a big problem.
So that was the next question I was going to ask. How do you discern who is the right partner and who's not?
This is the easy part, as much as it doesn't sound like it should be. I'll give you an example with Ryan. I treated him just like my wife. We met. We started going on dates. He worked right next to me. We worked side by side for a year. We were doing deals together. We were talking. We were meeting sellers together. We were going to listings together. We were doing it all together. And I watched how he treated his wife when she would call and how he talked to her on the phone. Was he reasonable with her? Was he respectful? I'd listen to find out what he did with his money. I'd ask him, and I'd kind of pick up those context clues. How expensive of a car is he driving? I wanted to know, is he like a drunken sailor and blows his money, or is he careful with it? Is he a good person? Is he going to treat his wife well, his kids well, his friends well, things like that? And if you look for the foundation of a human, don't worry about how he's going to treat you or the other people in the office. If you ascertain that he's a good breed of human, you're in good shape. So after that year working next to him side by side with my ears wide open, I knew it. But I've worked with other people after that time. I said, nope, not going to fly, dude.
Yeah. So it really is just like dating, of just observing how they treat other people and how they run their life.
Yeah, we weren't doing any kissing or anything, but a lot the same other way.
Well, and on that, Logan, we have a mutual friend. Tim Macy was my first realtor I ever used to buy and sell my first home. Became great friends with the Macys over the years. Alice was coming along to listing appointments with us, having before she was potty trained. She just celebrated her 10th birthday. So tell us a little bit, and we've had Tim on the show. You're going to be right around our 100th episode. Tim was right at the beginning of when we first got started.
Really?
What about Tim in particular made you want to work with him on some of the deals you guys have done together, maybe as a passive investor or just in general?
It starts with a good person. Like early on in my career, I remember listening to people say, don't do business with bad people. And I just needed to earn money. I would do business with anybody that I could earn with because I needed it. But as I got more experience, I realized you can't fix a bad person. You can't do a good deal with a bad person. And that really matters in our personal life too. When I met my wife, same filter was used to vet her, so to speak. But when I met Tim in Pawn, Tim rolled into a flip house, my first flip house in San Antonio in 2015. I'm like fixing the cabinets myself. And he walked in with some investors from California. And we just got to chat. He seemed like a cool guy, but they were in and out. And we talked a few times. He was interested in the investment space back then. And we just started spending time together. Him and his wife came over, right? Alice was really young then too. And we got kids and we just clicked, and they're great people. And our businesses are so different, but we are happy to have them as part of our life. It was really neat because both of us came from, not well for, just middle America folks, I guess, but we both kind of ascended in this similar trajectory. And it was really fun to have that to share with them. So as we grew and we were willing to take capital on the bigger deals, he was at the time where he was earning more capital, earning more money. I'm like, this is a great match, dude.
Yeah, no, absolutely. And it seems like you've had a lot of success in finding partners. Do you have any failures in that you have personally experienced, or having been in the education and coaching space, any clients of yours that have really gotten screwed over by picking the wrong person?
I've been lucky. I've done a really good job of picking because I've watched for so long before I'm willing to say, come be a partner. I do have one guy that was a partner. We've had one partner leave. He didn't have the exact same values as us. And there was some amount of time where he was getting resentful and his business wasn't doing as good as the other guys because he just, frankly, it wasn't as good. He didn't put in the work. He wasn't as bright. And that was my mistake. I overlooked that during the time that we worked together. But it was really easy to understand. We sat down, talked about it, said we're going to wind this down. He wanted me to give him a bigger share of the business or start spending more time with him. And I said, well, this is a great time to talk. I think we should just wind it down. And he was shocked. But he was almost coming to retrade me. And I thought, I'm not giving you a bigger share of this business because you're not as productive. My time is finite and become valuable. So that's a multi-million-dollar seat you're sitting in. And I don't want any more partners. So if you can't produce at that level, I'm going to put somebody else there. And so we made that swap. Yeah. I mean, it was tough. You work with people for so long, it gets real personal. I know he was hurt, but it was the right answer.
Just anyone that in clients potentially that have gotten screwed over. Because I think something that we've been trying to focus on, Dan and I manage a Reg D 506C fund, and we've started to meet people that are allegedly really big time in the private equity world. But it's hard to sniff out the bullshit sometimes. And I feel like that's something that we're really focusing on, is honing in our bullshit radar when it comes to picking the right partners, picking the right investors. Because I will pivot the conversation to financing in a few minutes, but everything's a two-way street in business. And if you pick the wrong person, you can really, really get yourself screwed over.
We've never raised capital at a large effort. This has just been our money, our own credit. And then, we stumbled across a couple deals that were just bigger than we were used to, but they're great deals. So we just reached out to close friends and said, do you want in on this? So it's not like we're, putting together a fund and need that amount. So we haven't done it that way. Another thing, well, this doesn't totally answer your question, but you mentioned customers or coaching. In coaching, we've made sure to get people there to an acceptable level of experience before they came in. And I guess you would want those same people in the private equity world up to a minimum level experience so that you're dealing with an experienced player and you're not having to teach them how to go from 0 to whatever number. You're taking them from whatever number to better. So in our coaching program, we've really worked hard to make sure you get folks that had experience and are already earning a living in real estate instead of taking some guy from Dell Computers and teaching him real estate. We don't do fundamentals. We take them from good to better. When it comes to that world, it's hard because unless people can truly show you everything they've done, open up your computer, dude, show me your deals, show me your books. I would be asking for people's financials, and I would really want to know a lot about them if you're going to potentially marry multi-million-dollar situations together. I've never done a deal with anybody who I wasn't personally friends with or had known for a long time already. And I can just inherently make that decision. But with y'all, if you meet someone and form a business relationship quickly, I don't know. That's inherently tougher because of the time.
Yeah. I like what you said about quickly there, and how with your partner, you sat next to him and worked with him for a year and got to observe him both in his personal and his professional life. Something I wish I would have done earlier on. But got to talk about financing, and you just mentioned you're using your partner's money. Now, is that just something you had, stashes you had built up from the flipping earlier on, or where did that come from? Because capital is one of the biggest constraints for most of us in the land space, especially.
It is. Well, so one of the reasons I like this distressed real estate is because it's a very efficient use of capital, and real estate is not necessarily an efficient use of capital model. Operating businesses are more efficient with capital. If you're going to go, I don't know, start a widget manufacturer, you don't buy the building, you lease it. You do buy a bunch of equipment, hire some people, but it's a lot less expensive to start a business most times than it is to buy real estate. But the reason I like distressed stuff is because it's so efficient with capital. I might spend 10, 20, 30, 50 grand to buy something that can make me hundreds of thousands. That's a great use of capital, very efficient, high returns, and it required a lot less dollars up front. I was buying land for $5,000 a piece. I was just an oil field dude and I had the money to do that. But the next phase of that is being very, very careful with your retained earnings. I would distribute 10, 15% to myself. I'd pay my taxes, distribute 10 or 15% and live off that. And I mean, my first couple of years, I lived off 40 grand a year. It wasn't great. That was a lot less than I made in my job, but I was building this equity in the company, cash, good tax returns, good financials. So that really grew quickly when you're really aggressive. But then I went to the local banks to just ask for credit lines. So a couple million of this one, a couple million at that one. And because we had lots of cash, they realized that we were prudent. We had good financials. I mean, they were giving us unsecured credit lines for millions of bucks at, great rates. So that really was a whole new phase of our business with a lot more capital.
Yeah, I think the credit lines are underutilized because Chase gave me an unsecured line of credit for just shy of 200 grand for just my credit score and a couple tax returns. I didn't even try and push it, but probably could have gotten that a bit higher. So that's
So you can use that for like your house flip, like use that for one house and exercise that thing, draw it down, pay it off multiple times this year. Show you're a good user of that capital. Next year, go back for double. Next year, go back for double. You'd be surprised how quickly it becomes $5 million.
That's good advice. I've been doing a lot of transactional funding with it and that sort of thing. So I will definitely do that. Now beyond like
over time. I mean, I've been now doing this for 10 years. By year 3, I could make $1 million in 1 year. You can see how that could grow. And if we're not buying Lamborghinis and helicopters and mansions and shit like that, that's how the business is the most important part. That's our golden goose. And we built that. Now that that's built, everybody's lifestyle is starting to appreciate a little bit because there's access.
Yeah, and I think what you just said there is really key. You're 10 years in, and it's been slow and steady. And I just think that so many people have unrealistic expectation of what they can do in real estate in a year or 90 days because of a lot of the coaching courses and gurus, but underestimate what they can do in 5 or 10 years.
Yeah, you're right. I don't know how to explain it any better than you just did. A lot of people are talking these days, like the Alex Hormozis of the world. They talk about these kind of subjects, or Gary Vaynerchuk. That's right. It takes a lot of work. You got to keep doing stuff, and you want to get distracted by something bright and shiny and new. But what you're doing is work. Just keep doing that. Make it better. And you'll look back over a career and be really surprised at what you did. But, these Miami, Florida crypto bros driving Lambos on Instagram, like, I would even look at them, not just a couple of years ago. I'm like, how the fuck does this 25-year-old have 3 Lamborghinis and a penthouse? I can't even afford that. And I'm like doing good business. And I did finally realize it's all fake.
Yes.
Yeah, absolutely. Well, and while we're talking about people that have influenced us, investors, I see you post about Warren Buffett. I love Warren Buffett. And Buffett said that it's wise to be fearful when others are greedy and to only be greedy when others are fearful. My personal stock portfolio has gone down about $80,000 in the last 2 days. That sucks.
But now it's time to go.
Now it's time to go. So how are you, this weird time in the market, we're recording this on April 4th, in whatever Trump called it, of all those sweeping tariffs, the stock market is plummeting. Mortgage rates are ticking down just a little bit. The real estate market, it's up in the air. NAHB successfully negotiated that lumber from Canada is not going to be included in the tariffs, which is good for us that are building. How are you reacting to what's going on? Because there's a lot of fear and a lot of uncertainty in the market.
So there are two. I've had 4 calls this morning with people asking them their opinion on stocks. I'm watching. So there are 2 times in my life where a similar event happened. One of which was when I moved to San Antonio, or before I moved there, I started buying land, and I really thought this was my move. I just didn't know yet. And I invested almost everything I had, 95% of my net worth into land. Thank God the market shifted and it became worth lots of money and it was huge. The other time is when COVID happened and the stock fell through the floor. At that time, I had some capital, and I thought, man, this is good quality companies for a good price. Like, how could you mess this up? It's on sale. So I did really well then. But I still look back on both of those events and say, why didn't I do more? I knew it was right. Well, stocks are getting shredded right now. High quality. Like, if you look at the MAGS, MAGS, it's an exchange traded fund for the top 7 largest by volume companies in the S&P 500. Dude, it's down like 15-20% from its last 12-month high. That's the best quality companies you're going to buy in the United States on sale for 20%. So right now, I'm actually moved a bunch of cash into my stock account, and I've started averaging in, because you don't know where the bottom is. Does it start to rebound tomorrow? Don't know. A lot of people think it hits this bottom, flutters for a while, then kind of starts to recover. But I've been kind of adding in little, but I'm watching because I'm really ready to buy high quality, and sometime in the near term, it's going to be time to buy a bunch.
That right there is like you have to worry about, you don't want to catch the knife as it's falling down. But if your investment thesis is long term,
Yeah.
then it doesn't exactly matter. But
So that's what I'm doing. So I don't care if I if I get it here or here, who cares? It's on sale from what it was. And if you look at the stock market the last 100 years, it goes this way. You can't mess this up except for if you sell too soon.
Yep. Yeah. So this is something that's on my mind, and I always like to ask our guests who have a profitable business. Well, I have a couple different questions I want to ask, but you're in Texas. Texas has some of the strongest fundamentals in the whole country as far as people moving there and for the long-term outlook of real estate. But then at the same time, there's been just a massive influx of new units, at least in Austin, I know. I believe in a lot of the Texas markets where rents have come down, things have softened, there's an oversupply of inventory, but the fundamentals are still there. So are you buying and holding rentals of any kind?
Industrial, yes, but I stopped doing the residential rental oh gosh, been probably 4 years, I guess.
Okay. Just because of the management?
Yeah, and I stumbled across my first warehouse one time. This was about 4 years ago, 5 years ago, and it was a great deal. The demand was high. It was very simple, and it was a $500,000 warehouse, and all my rent houses were like $100,000. And I remember thinking, this is 5 times the value of the rent house, but it's still the same amount of work as one unit. So the warehouses I like nowadays are a minimum of $1 million. The best one I got is about $4 million, but I usually want to pay about a third in cash and equity. The balance, I'll use debt for it. A lot of times community bank debt. And as long as you get a fair purchase price, it'll cash flow. 50% of your income will go to debt service. The other 50% is cash flow. So cash flows from the beginning, great return on your cash. Warehousing is pretty safe. You get a fair price. There's a huge demand for it. So that's what's happening right now, I think. Now, I have had some potential tenants that were going to sign leases and back off a little bit. I've had that happen during this trade talk, but typically commercial real estate takes a year to lease anyway. It'll be all right.
Yeah. Yeah. And one other question that relates to this, and something I think I've made the mistake of, I learned about real estate through Bigger Pockets. I read Rich Dad, Poor Dad when I was in college. I bought a duplex when I was 21, and it was all about buying rental properties, right? That was my whole thing. And in hindsight, I kind of wish I had bought fewer rental properties and kept more cash in the land business and multiplied faster. So do you have a certain amount of, all right, if I make X dollars, X allocation goes to stocks, X goes to buy and hold industrial buildings? How do you manage that?
Well, I mean, there's probably more to it, I guess, I'd say, than that. But, I've been working in the last couple of years to organize my balance sheet in a way that, at this point in the business, let's just say one of our partners gets hit by a bus, or like the other partner I started this with, let's say he gets hit by a bus and financing responsibility and creditworthiness falls directly on me. 24 months ago, I couldn't float this thing with my creditworthiness by myself without him. So I've worked on building my balance sheet in a way that would be very attractive to that. So my modeling of it may not be as good for you as a different plan might be, but I've worked to have a lot of liquidity on my balance sheet, and I've allowed the companies to use more short-term debts or credit facility instead of the cash. We have the cash, but I distribute out of the companies and use it and keep it personally because it looks really good on my balance sheet. And the guys were turning their inventory quick enough, so we pay for a little bit of interest. It's not that big a deal. So it's a shift in like capital use. But for me, I like to see a fair amount of it and be liquid. But other liquid assets like stock market, for example, you can liquidate in a day if you really need to. So I like that because it gives you upside exposure and a little bit of dividends maybe, but it shows up, as a short-term asset on your balance sheet. So I didn't answer your question well, but that's kind of been my perspective lately.
Okay.
Well, and it's good perspective. And I think one of the things that people that are listening to this should take out of it is, we've talked a lot about the niche of the methodology around your acquisitions component for your real estate business, but you're still investing in the stock market and cryptocurrency potentially. And I feel like a lot of people are just so dogmatic in their approach to investing of they should, people will tell me, why do you have any money in the stock market? I'm like, because the most brilliant and wealthy minds on the planet do. And I'm not smarter than them. But I do want to ask a question about Texas. You do a majority of the business in Texas. I grew up in Texas. I, lived in San Antonio for a while, went to grad school there, started my career there. And I think San Antonio, Austin is going to turn into DFW in the next 30 to 50 years, if not sooner than that. People forget how big Texas is. It's fucking enormous. You drive in through Beaumont, you see the sign for El Paso 990 miles away. What markets in Texas do you feel like you should be focusing on versus ones that might not make sense to focus on currently?
I like to stick to the big MSAs. There's stability there. There's demand there. We've done a lot of deals in small towns. We've made a lot of money in small towns. But when things change, a market changes, interest rates shoot up, all these things happen. The big MSAs are still more liquid. They still have more demand. You have more comparables. There's just more utility there. So I try to stick to the big MSAs. Let me go back to something we talked about right before here when you're talking about allocations. And you talked about, should you invest it or should you put more money in your business? A lot of people get into real estate because they think people get rich in real estate, and some people do. But more oftentimes, people get rich in an operating business and put that money in real estate. Well, you don't realize that until you get knee deep in real estate. You got all these rentals and you're doing all this work. There are a lot of guys that I would work with in our coaching group a couple of years ago that, it sounds crazy, I encouraged them to liquidate all their rentals. They had hundreds and hundreds of thousands of dollars in equity. It's just sitting in their rent house and they're cash flowing $300 a month after debt service and taxes. And he didn't have the money to buy these land deals that were like smoking good deals. He's like, oh, go get hard money. Like, sell the fucking rentals. He turned around like $700,000 in cash. And I'm like, you can use this in your business. This is a real estate related business, but this is a property ownership. Turn your inventory, use this cash to buy and turn that inventory and make real money over here. And who cares about those rentals, man? You make so much money in your business, you figure out what to do with the money once you made it. So that's a shift in perspective where a lot of people miss that.
Well, and I think what people forget, it's like kind of what Dan was saying of we were sold this vision in the 20 teens around bigger pockets and listening to it and, the 1% rule and all this other stuff. And it's great. Real estate is a great asset to purchase. But I think that, if your risk portfolio when you're in your 20s and 30s and 40s is a lot different than when you're 70. And if you can build an operating company, and the niche can be real estate or widgets or whatever, and figure out how to produce consistent cash flow and have good income, then you purchase real estate for the purpose that what we purchase real estate for now, which is the tax benefits of depreciation, long-term appreciation. Cash flow is kind of the last thing. You don't want it to negatively cash flow, but it's not going to make you rich. Real estate can help preserve your wealth, but it's not going to make you rich. And Logan, we really want to be conscious of your time. We know that we're at the top of the hour now. One question we do ask every guest, and I know we got through a lot, but we also got through about 1/10 of the questions that we wanted to ask. Are there any questions that we did not ask you today that we should have asked you?
Oh gosh.
You can only pick one.
I don't know. I mean, let me just bring up a topic that I touched on a little bit, but it continues to continuously be very relevant. The quality of talent in your organization, you don't think it affects you quite as much, and you think it only matters for a big company like Johnson & Johnson or something like that. But I think it matters in our business more than Johnson & Johnson because you have fewer people there. And I read a book,
Steven Schwartzman.
Thank you. Yeah. This dude's brilliant, man. He's one of the best one of the most important investors of our era. And when I read that book, he talked about talent and quality of people so much. And this was, I don't know, a couple of years ago. I just remember thinking, like, they're big. They can afford all this talent. They got all this money. But it applies to our scale, too. And sometimes it takes a little bit more dollars to pay somebody. But if you pay someone 10 or 20% more, that's a lot on a pay scale. But take your worst employee that you ever had, and then take your best employee that you ever had. Is that employee more than 20% better than that employee? They're like 200% better than that employee. So for a small 10, 15, 20% lift, you can get twice the person. Like, I'm a believer of finding the best quality you can get and pay them a little bit extra, and everything around you. All boats rise with the tide. And they're going to help you do that too. So I don't know. That's been a theme that matters for me lately. So
Yeah, and one point on that for people that are scared for their first hire or adding an additional, salary or FTE to their organization, you're not taking on 12 months of risk. You're taking on 60 to 90 days of whatever their salary is, and if they're not performing in that time, then you can get rid of them. And that right there is the gambler that
that's exactly how I say it. People say it's 70 grand a year. I'm like, no, dude, it's 5,500 a month. Fire them in 3 months if you hate them. That's great. I love it. Thank you for saying that.
Yep. All right, Logan, we're already over, so we got to wrap it up. Where can people find out more about you?
Go to Google or Instagram. My name, Logan Fullmer, right there on the screen. I'm easy to find.
Awesome. Well, guys, this is Dan Haberkost, Mason McDonald, and Logan Fullmer with the Big Picture Blueprint, signing off.